and good morning, everybody. It's a pleasure to meet all of you this morning. Happy new month. I'm excited to read words of encouragement that we are getting on the comment section, and just to appreciate those that are joining us from the different spaces across our continent. Thank you so much for joining us. My name is Boniface Mutinda. I am the communications manager at Kenya Community Development Foundation, that is KCDF. And like what Jennifer has mentioned, we are very excited to partner with LightUp Impact and of course with support from Femi Foundation to bring you this series of capacity building and capacity strengthening webinars and sessions to enhance our organizations and to make sure that each organization then our systems are in place, which are very crucial in terms of effectiveness in the work that we do. So briefly, allow me just to mention who we are as KCDF for those that maybe are joining us and are hearing KCDF for the first time. So KCDF is a community foundation that was founded in the year 1997. Our work is to support sustainable community-driven development in Kenya. In what we do as KCDF, we ensure that communities are at the center of development, and actually communities are able to be on the driving seat of every development that undertakes around their different localities. We believe that actually lasting change is possible when those very communities, they initiate and drive the development agenda with very little external support. And therefore, these sessions of capacity strengthening are very dear to us, very close to what we do, and we are very excited about this because we know when organizations' financial management systems are in place, then the credibility of the work that you do, the effectiveness of the work that you do is going to work with no challenges at all. And therefore, that's why we're excited to bring you to this conversation. As KCTF, we're excited and we thank our partners, Femi Foundation and LightUp Impact, for making this a success. I want to wish you a very wonderful moment, even as we engage, as we learn. Let us participate, let us be active participants, and let us learn as much as we can. Thank you so much, and let us begin learning.
Colin Muga is a financial management expert with over 5 years of experience helping SMEs become investment-ready and secure funding. He has partnered with organizations like the World Food Program, USAID, UNICEF, and UNFPA to drive meaningful change in underserved communities across Uganda. Specializing in developing tailored financial management training manuals, Collins has conducted impactful sessions on record keeping, management account formulation, and strategic financial planning. His efforts have strengthened the financial stability and operational efficiency of organizations, contributing to their sustainability and empowering communities to build resilient futures. So it means today this can be, we are dealing with a trainer who really understands the sustainability of our CSOs. With a steadfast commitment to creating lasting impact, Colin continues to equip organizations and communities with practical tools and strategies for sustainable growth. So Colin, let me take this opportunity to welcome you as you officially take us through the second session on financial management, as we look forward to learning, getting empowered, and also strengthening our capacities as CSOs. On my end, I will be supporting in terms of just time management. So once in a while, I'll be interjecting to just, let you know how much time we have. So with that, I hand it over to you, and I look forward to a great session ahead. Most welcome, Colin.
And before we pretty much go into what day 2 looks like, just to try and jog our memories, we'll just go into a small short quiz. So this quiz, we shall just be trying to see what knowledge did we get from the first session, and what areas maybe didn't we cover well, and yeah, just to give us insights on maybe if we did a good job on your end, or if there are areas that we can really improve on. So I'll hand this session to Valeria. She will be sharing her screen shortly, and she'll be sharing a link as well in the chat. So when you go to the chat, there should be a link that you can click, and that link will redirect you to a website, and yeah, there will just be a number of questions. So shall I just give it a couple of minutes for the majority of the participants to just access this link and then be in position to go through it. So I'll just give about a minute to the participants to just click that link and redirect to the page. Okay, I can see some people have already accessed the link and we're having some submissions come through. So the first question is basically we're trying to understand what is the primary purpose of financial management in an organization. So we have different options. We have the first option, which looks at to minimize the number of financial reports. The second is to ensure compliance with only donor policies. The third is to plan, organize, direct, and control financial activities. The next is to eliminate all financial risks. We're seeing some submissions keep coming, more submissions coming through, so just keep sending those in. As I saw, we're about, I think, 80 people on the call. So it would be essential if at least 3/4 of us can be able to respond to this question. And then we'll be moving on to the next question. So yeah, still we're trying to understand what is the primary purpose of financial management in an organization. This was something we went through in the first session. And basically we were for those who are not able to join, in the first session, we are really trying to understand the basics of financial management. And through that, we went through various steps that one can instill different financial management principles in their organization. So based off that information, I believe this should be a question that people are able to answer quite well, because yeah, we tried to really dive deep into that session. We even covered, I think, some of the building blocks of financial management. We tried to understand how can one really try to better their operations, because yeah, financial management is usually a pain point for a number of NGOs, those at the early stage, as well as those at the growth stage, and even those at the maturity stage. We usually find that they all suffer with instilling this financial management in their organizations. So we have about 32 submissions as per now, and I believe we can be able to get more, because we have about, we would say about 70 participants in the chat. So for those who are just joining, you could just click on a link in the chat. There's a link in the chat, and that link will take you to this financial management quiz. And when you get there, you just have to try and answer the questions that we have there. So the first one is that we're trying to look at now is what's the primary purpose of financial management in an organization. I think probably Valeria could move to the second, because I think it has stalled there for quite some time. So could move to the next question. And I believe there are those who have already tried to attempt it.
Yes, is the third question the correct one, Collins? Can you comment on that if most of the participants answer the right way?
Okay, so yeah, for the first question, while we're trying to understand what is the primary purpose of financial management. So we can see 33 participants got that right. So the primary purpose is always to plan, organize, direct, and control financial activities. So I think, as you remember last week, when we were trying to go through what financial management tries to do, we're trying to really see how you can plan your activities of an organization. And under the activities that you have planned, you can see where you can fit in different financial management tools, as well as during the organization stage where you're trying to really implement. There are also different financial management tools that you could fit into that. And also directing, there you're trying to direct resources at different activities that you have set out to fill in a financial year. And also you're trying to control the financial activities. So at the end of a financial year, you should always go back to the records that you have been in position to come up with, to see your transactions and to assess whether what you did is actually what you had planned to do. And also try to see what's the variance there. If there's any variance, then you try to assess why did this variance come up from. So yeah, that's the primary purpose of financial management in any organization. Could be an NGO, could be a community-based organization, or it could be a normal business. Also your day-to-day life, there's always a way you can use these financial management principles as well. So we're moving on to the second question. And here we're trying to understand which of the following is not a key benefit of financial management. So the first option, we have minimizing fraud and theft. The second, we have enhancing accountability to donors. The third is reducing the need for financial reporting. And the fourth is supporting organizations in making critical financial decisions. So under this question, we're trying to see which of all these different steps, of all these different options, which one is not a key benefit of financial management. So what we're trying to understand here is, if we're trying to instill financial management principles in our organizations, which ones of these are the reasons why we'll try to put these principles into place, or these various tools that we're using into place, which is a reason that we shouldn't be putting, which is not a reason for us putting financial management principles in place. So that's what we're trying to understand here. So for those who are just joining, we're just going through a quiz, and there's a link posted in the chat. It's a Mentimeter link. So when you click that link, it will take you to this quiz, and you'll be able to fill in your submissions. And also for those who are not able to join us for the first session, we just went through understanding the basics of financial management. And basically here we are trying to see why should an organization think about financial management before they even think of other areas or the projects that they are maybe already implementing. Why should they try to instill financial management into their organizations? So yeah, we're just now trying to look at which is not a key benefit of financial management. So that we have received 29 submissions and 31 now, and they're all saying reducing the need for financial reporting. So that's the correct answer. So minimizing fraud and theft, that's a benefit of financial management, because usually as an organization takes off different employees and different staff, there's always a lot that you may not know about this stuff, and also the world today is changing. So not everyone is entirely honest in all the work that they do. So that's why actually people usually come up with different financial management checks. And what these checks really try to do is try to minimize fraud and theft. So as I mentioned, I think in the first session, sometimes you realize that a number of organizations will figure out that they have incurred losses, or money has been diverted after a long period of time. Sometimes it's after 5 years or even more, but that's because their financial management systems are not in place. So one should always have both internal and external audits, and should also have processes that try to prevent these risks from happening, or try to catch them much earlier. So the second is enhancing accountability to donors. So the mere fact that I'm speaking to the majority of people here are from a number of NGOs, I realize that most of these organizations always have different donors who come in to try and support what you are trying to target, or what you're trying to achieve in the future of your organization. So usually when these donors also bring in these funds, they want to see the accountability of how have these funds been spent, How have they impacted the project you're running or the individuals that you are trying to support and create impact to? I've had an opportunity to handle a number of donor opportunities. So they will always come and ask, okay, we gave you $100,000 to try and support smallholder farmers in vulnerable communities. How have this supported? What activities have you spent on? And what have the results been? How have their livelihoods been sustained? So that's another area, because you have to report on the usage of the $100,000. Did you use all of it? Was it diverted to the right processes or the right activities, or did you divert it elsewhere? And then reducing the need for financial reporting. That's not a key benefit of financial management. So that's the right answer, because financial management is at a later stage tries to look at financial reporting. So after all this information is combined, then how do you report it to your different stakeholders? So you have different stakeholders over the board. They could be both internal, they could be external. So how do you try to provide this financial information to them to give confidence in your organization to actually support it, or maybe not go forward with supporting it, or how can financial management support on that? And then the final one, which is a key benefit, is supporting organizations in making critical financial decisions. So one of the topics we're going to dive into today, we'll look at actually budgeting. And if you're actually practicing this in your organization, you're able to know that, okay, I'm having $100,000 coming in as income. How am I trying to distribute this in the different financial activities? And you'll get to know whether you should take on extra staff based off the budget that you have, or you can't afford them. At times you may need experts or professionals in your organization, but you do not have the budget line, or let me say salaries, to afford them. So that helps you make that critical decision, and then you try to find a different way around it. So Valeria, I'll move to the third question, the third and final question. And here we're trying to look at which of the following is not a principle of financial management. So when you're trying to also come up with different financial management processes in your organization, you always have to link them to the different principles of financial management. So the first is one of the options is accountability. The next one is transparency. Is that a principle of financial management? When you're coming up with these processes, should there be transparency or not? And the third is looking at viability. And here we're trying to also understand if you are coming up with different financial management processes, do you need the principle of viability? And what viability is, for those who maybe weren't able to attend our first session, viability just tries to look at a company's ability to meet its ongoing financial obligations and also try to sustain its long-term operations. So yeah, here we're trying to look at its viability, a principle of financial management, or it's not a financial management principle. And the last option is secrecy. So secrecy is basically, if I instill these processes, am I trying to be secretive in what I'm doing or not? Am I trying to have these processes in place to be secretive about my organization, or am I not? So yeah, those are the three we're trying to look at as the principles of financial management. So we'll just give it a few more seconds for maybe a little bit of more submissions. And yeah, for those who are just joining this, we're going through this financial management quiz. And there's a link that was pasted in the chat where we're trying to understand. There's a link pasted in the chat. When you click that link, it will reroute you to our website. And that website will have this quiz where you can go there and try to fill in your different submissions. So I'll just wait to have maybe 30 or 35 submissions, then yeah, we'll be able to dive into the next topic, which will be into the next topics that we have planned for the session. So yeah, I can see the first session was quite insightful based off the very first 2 questions from your submissions. It shows that you actually got to know about financial management or already had an understanding of that topic. So, and this could have been maybe a refresher, or also those who are trying to instill these processes, trying to learn from the different topics that we went through. So which one of the following is not a principle of financial management? So the first option is accountability, and that's a principle of financial management. When you always try to put these different processes into your organization, accountability is key, because as an organization, you're always accountable to people, you're always accountable to your stakeholders, you're always accountable to your staff, you're always accountable to the donors who are providing you money. So financial management, as you're trying to instill it in your organization, you should think about accountability, the different processes. If I'm bringing in record keeping processes, how is that going to support in my organization? Maybe bring up accountability. And that's pretty much straightforward, because when you have the financial records and you're having these internal audits at the end of a financial year, you're able to show your stakeholders the different transactions that you went through, based off also the different accountabilities that you had. A number of times I've interacted with donor agencies, and what they're sharing is they're giving different individuals money to do certain activities, and when you choose accountability, there's a challenge.
Colin, just to let you know, we have 1 more minute for this session before we proceed.
Okay. Thank you, Jennifer. Then the second is transparency. Always, as you instill in this process, everything has to be transparent. So there shouldn't be any secrecy in what you're trying to do. And that's what makes the last answer correct. So we're always trying to be transparent in these processes. Do not be that organization that tries to always draft, let me say, audit reports for different stakeholders. You'll find one has audit reports for donor agencies, audit reports for their suppliers, audit reports for the different taxation authorities. So let's try to just be compliant on everything and have one document or one process that's really transparent. And then viability is what I said, whereby we are trying to see if a company has the ability to meet its ongoing financial obligations and sustain its long-term operations. So this is a principle that one should also instill, because we're running these companies for the long term. So with financial management principles, processes in place, we'll be able to know where we stand with our financial obligations. Do we have a cash flow burden? We have a high burn rate for the cash. Is our burn rate so high compared to the incomes that are coming in? And how is that going to affect our future activities? So yeah, those are all the questions we had for you, and thank you for those who are able to participate in this process. And yeah, I'll start by looking at the overview of the financial planning. And that's basically what maybe does financial planning look like. And we'll go into the financial planning process, just trying to basically understand that this financial planning process, what are the things that one should look out for when they're trying to undertake financial planning. And we'll follow that with budgeting. So there we'll look at what budgeting is, what is a budget, and what are the steps taken to develop budgets. And after that, we shall also look at what financial record keeping is. This is something that we tried to look at in the first session, but it was just briefly. So here we'll try to dive deep into it because it's a crucial element for every organization, be it an NGO, be it a private business. It's always wise to have financial record keeping procedures in your organization. And then we'll look at different budgeting types and the budgeting process, as well as the different functions of budgets. And now we're starting this session is we're trying to look at what's the first word that comes to your mind when you think of financial planning. So as the different participants on here, we'll give you an opportunity. If you want to speak, you could just request to speak, or you could just unmute yourself. For those who are not able, you could just paste that comment in the chat of what comes to your mind when you think of financial planning. And I think I'll hand this session to Jennifer and Valeria just to look at those responses as they come in, and also to share about them. So I'll just hand over that now.
So as we wait for people to just share in terms of opening their mic and then giving feedback, I will share Jackson's feedback. He says budget, which is the same thing that came into my mind as well. I read Dixoni's comment is market analysis. We also have budgeting as well. Kevin also says budgeting. Athman also says budgeting. Valeria says forecast. So it's quite a different diversity into what our thoughts are. Martin says fundraising and resource mobilization. Nakure says budgeting and stroke goals. Waiting to read more. If you have two people who want to raise their hands and also mention what they think as well, you can also do that. They will give you an opportunity. So I want to read 3 more. And then if you don't have any hands up, I'll return it back to you, Colin. We have Rosalina, she says fundraising, resource mobilization, and budgeting. Then you have Lillian, who says how much you want to spend and how. So it's a matter of understanding how much you want to spend and then how. We have Bernard saying investing, and then Anita budgeting and operational plan, and then the last one is Rosfella says budgeting. So I think I'll return it over to you, Colin. We can be able to share more on that.
All right. Thank you, Jennifer, for taking us through that. And thank you for those who are able to share some comments about that. So we'll just look at what financial planning is. And on this slide, you can see that strong financial management begins with financial planning. And this financial planning is always going to be linked at how you try to implement this project or the different activities that you have come up with. So basically, financial planning is a strategic and operational process that aims to achieve organizational objectives. So it's already strategic and operational. So it looks at what are the strategic objectives that one has set out as an organization. I remember in the previous session, we went through what a strategic plan of an organization looks like versus a business plan. And a strategic plan will look at things like what your vision looks like, what's the mission of the organization, what are these objectives that you're really trying to achieve, and how do the different operational processes try to fit into your own strategic objective. Because if you have a mission and a vision, then you really should try to now understand what activities you're going to try and do to ensure that they fit into this whole strategic goal that you have. So the other says financial planning refers to the development of goals and objectives and the identification of related activities to support the mission of an organization. So really, as an organization, I keep telling this to most of the people that I try to support, that we should try to have a goal every year of something that we're going to achieve. And this is something that I talked about in the first session. So the goals always vary based off what organization you are running. If it's an organization that's for profit, you could say your goal for this year is to increase my revenue from, let me say, 2 million Kenyan shillings in the previous year to 4 million Kenyan shillings. So there you see you're trying to double what you are able to achieve as revenue the past period of time. Sometimes if you are an NGO trying to support smallholder farmers in different vulnerable communities in Kenya, you could first try to understand how many of these smallholder farmers that are in these vulnerable communities did I support last year. And there you would know, okay, last year, based off our different activities, we maybe supported 1,000 farmers. And having done an inline evaluation of the previous year, we saw that these 1,000 farmers, maybe we increased their income from let me say, a monthly rate of monthly income of 1,000 Kenyan shillings to monthly income of 2,000 Kenyan shilling. So you can now come up with your goal that could be looking at supporting 2,000 smallholder farmers to increase their monthly income from 2,000 Kenyan shillings to 3,000 Kenyan shillings. This all depends on what project you're trying to implement. But as I always say, your goal should always try to be something that's quantifiable. Actually, everything that we do in life, we should try to make it quantifiable, because that's how you're always able to go back to the drawing board. So this also poses into a reflection to your organization as well as your life. If usually there's anything that you're doing that's not quantifiable, then you should maybe stop it immediately, because how are you going to try and assess if you are being successful in it or you're actually failing at it? Because it's always the quantifiable element that helps us to know what did this variance look like, and then how am I going to try to adjust this going forward. So if in the previous year, maybe if after this yearly period you realize that you have not been able to increase this livelihood by these 2,000 farmers' livelihoods, so you try and see, maybe I was able to support 1,300. And then you go and try to now assess, based off the activities that you implemented, why weren't we able to mobilize these farmers better? What made them maybe not believe in what we are in our mission that we are trying to achieve? And then you come up with different strategies that can really support you with your whole-term development goal. So yeah, that's what the financial planning process looks like. That's what financial planning looks like and tries to achieve. And the final one says the process involves developing long-term funding strategies and short-term budgets and forecasts. So of course, having interacted with a number of projects, they will always vary on timelines. So these projects that you're running, it could be one for 2 months, 2 years, could be an 18-month project. It could be something of over 5 years, or it could be something of 3 years that's maybe renewable if you're able to meet the different targets that you've set out to do. And as you're trying to do this, of course, this process will always involve developing long-term funding strategies. And here you're trying to understand that this project I'm trying to run for the next 3 years, where am I going to get the different funding opportunities? Am I having a different source of income into this NGO? And by that, I mean, maybe you're just starting this out and you're maybe personally first injecting in your own money to try and push the growth of this NGO. Or have you been in position to secure some funding opportunities? And if you've been able to secure these funding opportunities, then how are you going to try to implement them over the 3-year period? The funding that has come in, is it for the whole 3-year period, or you've just received funding for the first year only? And then you try to devise strategies that can support you in meeting these different activities that you would have set out. So of course, as these different funding come up, it's always important for you to have a budget for this funding. So you have to know that, okay, I'm getting in an income of from the donors of about 2 million Kenyan shillings, but currently the activity that I have to do for the next 3 years, this is not enough. So how do I now try to work within that budget? Do I try to get people some hires or stuff that I need on a contract basis? What activities do I treat of higher priority, which will be medium priority, and which will be short-term priority? So also based off the funding that's coming in, you should be able to now try and do various forecasts. And what these forecasts try to look at is for the next 3 years, are we going to be sustainable with the income that we have coming through? And if not, then how are we going to try to bring in more money to ensure that there's that sustainability component? So it's always better to know these at the inception than you reaching into the third year of implementation, and then you're realizing that you don't have the funds to take you through that third year, and then you try doing things on short notice. So financial planning just tries to help you understand what you're doing over a year's period or the foreseeable future. So it's a really very key topic, and we thought it's something that we should try to go through and try to understand in depth, because it's really going to support the organization to know to mitigate some certain risks that you may incur because you do not have certain funding that you thought would come through. Because also usually as you're trying to get this funding, you always have to look at the risks of it not coming through. You have to prepare for the unforeseen circumstances. So you try to make those, look at those numbers and analyze them, that if this money doesn't come in, where does that leave us? And what can we try to do to ensure that we move forward with the project implementation, or do we halt it? What do we do? This has even been now currently a challenge. For example, since the American president cut off the USAID funding to a number of countries that have been supported. So for example, here in Uganda, most of the projects by USAID have now come to a pause. There are those that haven't yet. And yeah, as an organization, you always have to think about these extremes, because where the world moves today, it's quite robust. So you never see some of these things coming. And yeah, this could be something that you could look at to really try and understand how we try to implement sustainability in our NGOs as well. I understand NGOs are always supposed to be not for profit, but there are always different strategies one can come up with to try and have more income coming into the NGO to implement more activities, as well as also support more vulnerable people. So yeah, that's what financial planning looks like. And we'll go to the next slide. And here on the next slide, we're just trying to look at what is this financial planning process? What does it look like? Or how do we try to come up with financial planning procedures in our organization? So I came up with a 6-step process, and this is just try to match the audience that I'm speaking to, which is pretty much the NGOs, but this can be implemented in different organizations. So the way I was able to come up with this is basically twofold. So at one end, it looks at how can an NGO actually have go through this process as an NGO as the, let me say, finance team of the NGO. And the second is looking at, in case the NGO did not have the technical capacity or the technical competence, what would an external person that they bring in try to follow to go through this process of trying to instill financial planning in the organization. So the first step looks at gathering client information, and this both looks from the outside of an external person coming in as well as an internal person coming in. So as someone under the finance team or someone in charge of this process, you have to really understand the organization, so the NGO at this point. You have to gather as much information about the activities that they do, the projects that they try to implement on a daily basis, on the projects that they're implementing for the next 3 to 5 years. And after you've had an understanding of that, you're able to come up with how you can support them in their financial planning. The second looks at establishing goals and objectives. So as you have really understood what the organization looks like, a number of its pain points, maybe its opportunities, weaknesses, or the strengths that it has, then you're able to establish goals and objectives. So I talked about goals in the past slide, whereby we're trying to have something quantifiable of what we want to do, the impact we want to create. And when you have these goals, then these objectives will directly feed into the goals that you have set up. So for example, if you have...
Okay. Just to let you know on time, you have 5 more minutes for part 1. Thank you.
Okay. Thank you, Jennifer. So after you've understood the goals and objectives, you move into analyzing the financial information you have. And this financial information will always vary. It could be the different financial records that NGO has. Maybe they could have a budget in place already. So you look at all this information, and that helps you now develop and present a financial plan to the different stakeholders or the top management in this organization. So here, as you're trying to present a financial plan, you've taken into account the client's the organization's pain points, what their goals are, and probably their historical financial information of what they've been able to do so far. And then we develop a financial plan going forward. And once this plan is developed, of course, it's usually reviewed by the top people, the top management, and these will now see if there are any different areas they should add to, and then they proceed to implementing the financial plan. And of course, when you implement this financial plan, you have to always envision the point of, after this time period, trying and monitoring and evaluating this financial plan. So did it really try to achieve everything that it was set out to do? So that's an overview of what the financial planning process looks like. And of course, as you're trying to have this whole financial planning process in mind, you also have to think of the different things that you should think about as you're trying to have a financial plan. So here we look at the financial planning pyramid of NGOs. And why this is crucial is because this all enables your financial plan fall into place. So we have the vision, and a vision is usually something that an organization sets out to achieve in the long term. So it should be something that's really very hard to achieve, and it's always a statement that based off what an organization is trying to do. So I had come up with a thought of a vision for, let me say, an NGO supporting smallholder farmers. And the vision is empowering smallholder farmers for sustainable prosperity and food security. So as you look at that vision that I've highlighted, it's something that's really long-term, because it's really hard to achieve, and it's something that should always, it's like your North Star, something that you try to look at every morning, that with every activity I'm trying to do, what am I trying to achieve in the long term? So sustainable prosperity of these smallholder farmers, and also food security. That's really something that's has been very difficult to implement over the past years. And once you have the vision in place, that helps you now structure your mission. So that mission is something that now just basically looks at the activities or that you're going to have to put in place to ensure that you meet this, try to reach the point of achieving this vision. So a mission I came up with was supporting smallholder farmers with innovative solutions, financial literacy, and market access to productivity and resilience. So as you can hear, that mission, it really breaks down the activities that this NGO is going to do to try and ensure that there is that sustainable prosperity and food security for the smallholder farmers. And then the objectives will just basically try to tap into the mission. So objectives of why you are trying to implement these different activities. And another, there will also be strategic objectives that directly plug into these objectives. So strategies are, as you are trying to achieve this mission, what things are you going to really try to do? And activity plans are now the activities that you implement. So under, let me say, financial literacy, you could have trainings like this where you try to ensure these farmers are able to know how to utilize their incomes versus their expenditure. Market access, you could try to also do trainings on what the market wants, how do they do proper post-harvest handling for their products to ensure that they're able to get a good price, and all the different activities. So that's how the financial planning pyramid looks like. And as you're trying to instill a financial plan, you should always think of these different activities. So now we've come to an end of the financial planning process. And now here, I'll hand it over to the participants to just come up with activity plans that they think should feed into the budget of your NGO organization. So as you're trying to come up with a budget, there should be different budget items, right? So there should be different budget items. So, and those budget items come up based off the activity plans that you're trying to do. And those I talked about in the previous slide. So what activity plans should you feed into the budget of your organization? So I'll hand this over to Jennifer to just moderate on this. And then after this is done, I'll just come back to just give insights on it, and we'll go into our next topic of budgeting. Thank you, and over to you, Jennifer.
Thank you, Colin. So I think we are waiting for the participants to share their questions on the chat. Valeria will guide me on that when she gets the questions. And also, if you have a question and you want to just raise your hand and ask it directly, please, you're opening the floor for 2 questions. So you can raise your hand and then we'll give you the opportunity as well. So let's wait for questions in the chat, and then anything that comes in the chat, I think Valeria will be able to take us through. So just a few minutes and a few seconds, and then we hear what is being shared in the chat. Also, if there are comments, I think let me hand it over to Valeria. If there are comments that you can read for us as we wait for questions to come in as well.
Thank you, Jennifer. There's no comment or question yet in the chat for now.
Thank you, Valeria, for that. Let me see. So I don't see any hand raised. So I think, Colin, I can hand it over to you unless a question pops up. We'll be able to, pick it up and then directly address it during the Q&A session at the far end. So I think I'll hand it over to you. We can proceed since I don't see any hand raised and any question on the chat.
All right. Thank you, Valeria and Jennifer. So silence always means 2 things: that either the principles are being well understood or I'm not doing a good job. So could just let me know in the chat if everything is okay, if I'm being well understood or not. Jennifer will share that with me. So hopefully it's the first where I'm being understood well. So
okay,
we'll just...
So let me interrupt you a bit, Colin. So I think there are some few things on the chat. Let me allow Valeria to read it out for you before we proceed.
All right.
Okay, thank you.
Okay, thank you, Jennifer. So Rose is sharing one of the activity plans that we put in place is capacity building. Very important, Rose. This is also something we've put in place at LightUp Impact this year. You need resources and time for that. Workshops, exchange programs, trainings. Again, Bernard is saying strategic planning is one of the activities. Very good. Let me see. Is a question from Charles Colin. Is the financial plan part of the strategic plan? And then we have another comment from Mohammed about administrative and operational costs. So for now, apart from the comments, there's only this one question from Charles. Is the financial plan part of the strategic plan?
All right. Thank you, Valeria. So I will answer that first question, which was I'll answer that question that was asked first. So is financial planning part of the strategic plan? So a strategic plan and a financial plan are quite different, but they go hand in hand. So I remember when I had shared a strategic plan, you're trying to see things like what your organization's vision tries to look at, and where you want, and the mission, where you want to be in the next, let me say, in the next couple of years that you're pretty much running this NGO and the different projects that you're running. So it also looks at some of the activities that you're going to carry out during that whole time period that are part of your mission as well as your vision. So of course, as you now try to implement these activities, then you're going to need a financial plan to try to guide you on how you're going to prioritize the different needs that you have, or the different activities that you have. So usually, as we are running organizations, we have a number of activities that we want to do, right? But remember, the world that we're in, it's always, we don't have enough resources. We rarely have enough resources to try and implement all these things. So I think this is even one of the principles of what is it human wants, whereby resources are always, they're never enough, resources are always scarce. So just as in your day-to-day life, whereby you try to look at having these resources, but you can't do everything that you want to with all of them. So you try to prioritize what you try to prioritize what really is required for now, and then the other things could come into play later. And that's how the financial plan really tries to support in the overall strategic plan. So with a number of with my experience trying to support different organizations, you'll realize that at the time when an organization is trying to implement various things, I always come to realize that the people running the organization sometimes try to go off from what their priority is, and they have all these different ideas that they want to really try to execute. But of course, at that point, they don't have the required resources to execute all these ideas. So we try to support them to see which of these ideas is actually a great idea, which of these ideas should be executed first. So we try to support them to try and prioritize based off which is high priority. So if there's this activity that really stands out to what the organization is trying to achieve, you start with that and then go to the medium priority. And if you still have some resources, then you can look at those of the lowest priority. So for example, you'll find an organization, they want to, let me say, buy a machine or an asset, but when you try to break it down, you realize that the asset that they're going to buy is not going to give them that much value. And this money should be literally implemented elsewhere. So that's how financial planning tries to fit into the different strategic plan. So in terms of the activity plans that should fit in the budget of the NGO, so here we're trying to look at different activities that we can really try to implement in our organizations. So for example, as an NGO, I had from the comments things like capacity building training. So based off also your target audience, I always refer to smallholder farmers because that's an area that's really passionate to me in the Ugandan space, because our economy is about 80% agriculture. So that's why I always keep referring to that. So if you're trying to impact these smallholder farmers, then you're going to have to do these capacity building trainings. These trainings could be on financial management. They could be on financial literacy. They could be on things like post-harvest handling. They could be on corporate governance. So those could be some of the different activity plans. And also, of course, as we're supporting these smallholder farmers, we realize, we realize that there's also that pain point of not having enough market in the for their produce. So if you're also trying to address that challenge of the market, then you see an activity could be maybe creating linkages to different market providers. So these market providers could be different aggregators, it could be different businesses, and so forth. There's also another challenge of access to finance. So this farmer cannot really expand his operations because they don't have the income to buy inputs that are of a good standard, or they don't have enough money to even expand from. They could have the land of, let me say, 3 acres, but the money they have, they can only produce on 1 acre. So how do you try to provide access to finance? You can do things whereby you have financial clinics for them and have different investors in the room to share about how they can go through this process, what things they should try to address, and also do linkages to different financial institutions that could support them in these activities. So that's what we're looking at there. And we'll now go into the next topic. And the next topic is we're trying to look at budgets and budgeting. So those are two different things. So we have what a budget is and what budgeting is. So I think, as I had earlier shared, the budget is usually a written financial plan for income and expenditure. So it's always income versus expenditure. So if you're trying to implement these different activities I've talked about, how do you look at the income that's coming into your organization versus the current expenditure that you have? At times, when you do these budgets, you realize that maybe the income that's coming in is not enough, or maybe you're overpaying your staff. And this is not me saying that you should, after this training, you should go back and cut what you're paying your staff. But yeah, it just gives you an idea of, am I making the right decisions in terms of different service providers that I'm onboarding, or the different costs that I'm meeting? Do they try to fit into the income that's coming into the business or the NGO? So a budget is based on a work plan. So as an organization, you should always have a work plan, and this work plan will always try to look at the activities that you're going to do. It's always good to try and break this down in, let me say, a yearly or 6-month level. So you could always have the overall work plan that looks at, let me say, the time period that you are implementing this project, but you should also try to draft a work plan that's now more targeted to the quarterly activities that you're going to do and what's that going to cost. Because if you don't have that, remember, with the inflation and with the current inflation and also different situations that are going in the world, what you could have planned today could change in the next few months. So it's advisable to have a work plan that could be quarterly. If possible, you could do this monthly, and you could always reflect at the end of this time period that for what activities that I set out to do this month or this quarter, what have been done and what were not done. Is the budget still there, or did I now use this money for other activities? So usually as we're drawing now an overall budget, it will cover certain period, either annually or monthly. And yeah, usually when we're coming up with this budget, it's always, we always look at least an annual process. Could be monthly based off the size of the organization, but it's advisable for it to be annually and you could just have some routine checks to see how that is going in terms of the implementation. So there's a whole process of how you try to come up with that budget, and we'll try to go through that later in the session. So the annual budget will show what income the NGO expects to receive and how it plans to spend and use this money over a 1 year or monthly period. So you have all these funding opportunities coming in. Let me say you have $3 million coming in. How are you going to try to budget for this? It's always easier to budget if you have low incomes coming in. But now when it reaches the point of whereby you have a high chunk of income coming into the organization, then that's why it's even more crucial, because any small step, you'll find yourself sliding into other activities that maybe you didn't plan out to do. So as the income coming into the organization comes about, there are always so many moving pieces. So it at times becomes even more problematic there. And yeah, that's why you should try to have a budget in place. And then the budget explains how much money should be spent and on what items during the year. So what are those activities that are the highest priority, which are medium priority, which are of low priority. And then based off that, you're able to know where you have to first spend the income that's coming in. So that's what a budget is. And budgeting is just basically, for budgeting is just basically the whole process of coming up with this budget. So it involves establishing realistic financial objectives, projecting future demands and financial resources, keeping an eye on managing income and expenses, and assessing the degree to which financial goals are being attained. So yeah, when you come up with this budget, then that's when the budgeting process starts before you even have come up with a budget. The budgeting process starts during the process when you think about having this budget in place, because before you even implement the budget, there are a number of steps you have to go through. So that's when it starts. And yeah, you try to now look at the point when you come up with a budget, and then when you try to assess the degree to which you stayed on par with this budget, or what level of variance was there. So if your level of variance is over 20%, then you know there's a problem that you're really not utilizing the funds as you try to do. And then you try to assess, was it because I gave maybe these activities a low price compared to what the market was demanding? Is it because of maybe you had to add an activity that you didn't plan for? Yeah, what really happened there? So for an NGO to carry out a project correctly and successfully, resources are required. So if also these resources are required, you now look at how do you try to get more of these resources into your organization. What things are you going to have to do? What different agencies are you going to have to try and reach out to just to support you with your financial plans? So NGOs are required to establish a solid budget to successfully finish a project, and an efficient budget facilitates your ability to plan. So yeah, this is always this why the budgeting process is key, because you're always able to highlight that how much income is coming in, how are you spending it, and is it something that will enable you to achieve the different activities or the mission and vision that you've set out as an organization. So we'll go to the next slide, and here we're trying to look at different types of budgets. So we have 3 types of budgets that any organization should look at when they're budgeting. So we have the operating budget. And the operating budget just basically looks at your day-to-day activities as an NGO. So as you're running your NGO, what are these day-to-day operations or activities that you're going through? So once you know these day-to-day activities, then you're able to know the different expenses that are associated to that. So for example, if you are an NGO that does not have its own physical space and you're renting out a space, that goes under the operating budget, because you know that for every month I'm going to have to pay this expense of rent. And also if you have to pay that expense of rent, then of course there won't be associated costs of, let me say, electricity, water, different utility costs to run your offices, could be Wi-Fi, things of that sort. So there always be those fixed expenses and variable expenses, and fixed expenses or costs. Those look at costs that don't really change based off the output that you put out in running your project. So a cost like rent, however much you do not even run any of the activity that you've thought out to do during a month, you still have to pay that rent to the landlord, because they won't really want to know why you didn't do any activity. So those are things that are really the fixed costs. Things like that are variable costs will be things like salary expenses of certain people. So for example, if you're going to do trainings and usually hire some people to support you on the trainings based off the need, then that's a variable cost, because that's really tagged to you doing the training. If you don't do the training, that means you're not going to pay this expense. But also salaries can also be fixed as well, because you have some employees that are maybe on fixed term contracts. So for example, if you have a three-year project that you are implementing, there are always those staff that you're going to need for that whole 3-year period. So salaries can also be fixed, and they can also be variable, because fixed salaries will always look at full-time employees. So these people who you need on that day-to-day, who are going to be there every day to try and implement your different project activities and objectives. And there could also be variable costs like steel, electricity. So electricity would come in, because maybe if you're not there certain days, people are not using that place, and that comes down. Another fixed cost could be something like Wi-Fi. If you are paying for, let me say, an unlimited Wi-Fi package, that means that however much people connect to this package on a day-to-day basis, you will still have to pay the same amount. So for example, if today one person used it and the next day 3 people, the next day 6 people, you're still going to find yourself paying the same cost. So that's a fixed expense. So after the operating budget, we have now the capital budget. And the capital budget mainly looks at, it usually looks at assets. So that an organization is trying to bring in. So it looks at purchases of large assets such as property, equipment, or IT systems that create demands on an organization's cash flow. So such things could be, let me say that NGO has grown to a point whereby they believe they need a van to transport its staff when they're going to do the different outreaches, the different capacity building trainings, or visiting the different areas that they go to. And an NGO realizes that now they have grown, they no longer want to rent different vehicles, and they want to actually have their own vehicle with a driver. Then that now looks at an asset, and that goes under the capital budget. So also as try to draw up a budget as the year starts, you're always able to assess that, okay, maybe this year our revenue, our income is increasing by a sizable amount, and we can actually afford this vehicle, and we need it to just create convenience for our staff and also the different things that you require. Maybe you could have laptops that have depreciated over time, and now you need to replace these, so that will all go under there. Maybe you've also been able to expand, and now you're looking at maybe setting up your own office, moving from an office space that you are renting to maybe trying to start now building up offices for your space. So that will come under capital budget. And the role of a capital budget is just to allocate these funds, control risks in decision making, and set priorities. So of course, as you're coming up with this, you have to ask yourself a few questions of the vehicle I'm buying. Is it actually key to what the organization is trying to do going forward? Is it something that's an urgent need, or it's something that you cannot do without other funds also there? What's the risk of having this vehicle, and can we actually mitigate these different risks? And the final one is the cash budget. And the cash budget just basically tries to tie both the operating budget and the capital budget. And it tries to take into account the timing of payments and the timing of receipt of cash from revenues. So basically what the cash budget does, it's like more of a cash flow management budget. So here you keep seeing that, okay, I've been able to have a revenue of this much, the expenses doing on that in that regard. If I've bought an asset, how am I going to try and phase these payments out? I remember in the first session, we talked about things like receivable days and also payable days. So this cash budget tries to look at those areas to try and see how you can better those going forward, because it's always good to have proper cash flow management. So as by the time a service provider is saying they need their payment, you're not now trying to enter your own pockets to be able to meet this payment. Or as organizations are starting up, there's always some things that they suffer with. But as you go growing, then you have to separate yourself as an organization from your personal expenditure. So those are the different types of budgets that we try to look at. And here we're now trying to look at what are the goals of the budgeting process. Why is there a whole budgeting process? We'll go through what the budgeting process looks like. But what's the goal of budgeting? So budgeting aids in planning of actual operations. So here, of course, based off on how an NGO is set up, there won't be, some will have one manager if they are just starting up. Others are going to have various number of managers who are going to support them in their different areas. So these different managers also support in drawing up a budget. And when you are drawing up a budget, you now get information from these managers to consider in putting into the budget. So this process gets managers consider how conditions may change and what steps they need to change, while also allowing managers to understand how to address problems when they arise. So the whole budgeting process, you budget for things, but at a certain point, there could be unforeseen circumstances. So it's always advisable to also try to have a miscellaneous component. And this is also an area you can always tap into in case these unforeseen circumstances arise. Then another goal is it coordinates the activities of the organization. So budgeting encourages managers to build relationships with the other parts of the organization and understand how the various departments and teams interact with each other and how they support the overall organization. So of course, usually you have heard of the story, you start a company as 2 people, or an organization as 2 people, but as you go growing, you're going to literally bring different people on board, and that's more moving pieces. So as this happens, budgeting helps you coordinate the activities of the organization. So you have to ensure that all these different people and the activities that they are doing, you're trying to think about them and have them onboarded into your whole budget as activities or as responsibilities or as costs. And then it also helps you understand how these various departments will support the overall goals of an organization. So if I have the finance team, what are their goals and how are they going to support in implementation of the budget? So the finance team will always try to look at the finances of the company or the NGO. So you're looking at what income is coming in, what are the costs, are we in the red? Do we have some reserves from the previous year? How can we utilize these reserves? And also the team that's implementing the different activities like capacity building trainings, they know that, okay, when we need support to go out for an outreach, then we're coming to the finance team and they're going to support in this way based also of the financial policies that they have. The third is communication to various, yes.
Allow me to just let you know on the time. We have 10 minutes for this, 10 more minutes for this session. Thank you.
All right, thank you, Jennifer. So yeah, the third looks at communicating plans to various managers. So it encourages communication of individual goals, plans, initiatives, and all roll up the support to support the growth of the business. It also ensures appropriate individuals are made accountable for implementing the budget. So when you come up with a budget, then you communicate the plans that everyone has to do. And then when it reaches that point when you are now doing an evaluation of how you are able to implement this budget, it also enables you to come down to the different managers to see the line items that they had and be accountable for that. So for example, why did they spend maybe less on these activities? Why did they spend more? And if they are spending more, where do they think that money is going to come through from if it wasn't budgeted? And also they can be able to communicate that, okay, we're now implementing these activities, but maybe what we had budgeted for is actually not enough. And then you try to look at how to prioritize different activities. So it also motivates managers to strive to achieve the budget goals. So of course, if you're being given a line item and this budget, then of course, the organization is going to expect you to achieve the goals that they have set out to. So you're able to understand why we gave you this budget item. Was the money spent? And if yes, it was spent, then did you actually achieve the goal that we set out to? If you didn't achieve the goals yet money was spent, then there's a big problem there. And yeah, you try to now understand why that happened. And then there's control activities. So managers can compare actual spending with the budget to control activity. So here you're looking at the actuals that have been spent versus what was planned. And then you try to create a comparison. And it also supports in evaluation of the performance of managers. So if we have provided this money to you and you've actually spent this money, are you actually meeting the targets that they were set out for you? If at any one point your manager is spending money without meeting the targets of set out for them, then there's a very big problem there. And yeah, you have to really investigate what's really happening. Why is the money being spent without any targets being met? So that's the goal of the budgeting process. And here we'll look at the budgeting cycle. So the budgeting cycle is basically a number of questions you should ask yourself when you are trying to come up with a budget under the different managers or as an organization. So you look at questions like, what are the objectives of the program or the project? So once you know the objectives of a program or the budget, you're able to come up with activities that will be involved. So that's why you see what activities will be involved in achieving these objectives. And once you know those activities, what resources will one need to perform those activities? Once you have an idea of the resources you need, what will these resources cost? Where are these resources going to come from? And at the end of the day, is the budget plan realistic? So it then makes sense for you to implement or to confirm a plan and a budget and start implementing it. When, for example, you don't know what resources you need to perform these activities and where these resources are coming, how much these resources will cost and where they will come from, because there you're as good as someone who doesn't have a budget. So the next slide now looks at the steps of the budgeting process. And we're going clockwise in terms of implementing the budget, in the terms of implementing the budget process. So you can see the first step, you always create a budget committee. And the budget committee here, this could consist of different stakeholders that your organization has. It could be the finance team, could be the COO, the chief operations, the chief of operations. Now it could be different people that you think are crucial for this process that can give insights, and also could also be the different managers that you have in your organization. So once you have a budget committee, then you're able to come up with different principles on what people should look out for when they're trying to create this budget, and then you issue instructions to the budget holders. So when you, of course, as you're implementing various activities, all those people are going to, the people in charge of those activities will have specific budgets, and those are what we call the budget holders. So if you have a budget that you are, you have a line item that you have been given an opportunity to try and implement, then the committee always issues instructions to these budget holders on how this should be implemented, the process of them maybe utilizing these funds or resources that have been given to them, because all that must always, the process must be the same. You can't have managers of a different budget item following different procedures compared to another. So you have to try and streamline that and offer those instructions. And then you set the budget objectives and priorities. So here you're trying to look at this budget that I'm implementing. What are we trying to achieve with this budget? And as you're coming up with these activities, how do they fit into the objectives and priorities of the organization, as well as the program or project you're implementing? And then you develop the budget proposal. So this budget proposal will always be like a first draft of what the different managers and the committee has come up with. And this should really be reviewed and approved by the committee. So the committee should look at, okay, based off the instructions that we delivered to the different budget holders, that have been able to have this in mind. And then they review if there are any areas they want to adjust, then those are done. And then the budget is approved. And after you approve the budget, you now start implementing it, after which you always have to come back after the period of the budget implementation has ended, and you try and monitor the execution of this budget. Monitoring also the budget execution is something you could not also wait for when the time period has ended. You could always come up with a process whereby, let me say, every quarter you look at how you're differing from the execution of the budget. Are you at par, or there is a variance, and what needs to be done to ensure that everything goes smoothly? And we now go into the functions of a budget at every stage. So the first stage is always planning. So as you're designing a new project, you always have to know what things are you going to need, what activities will have to be done, what incomes are coming in, and also what does the expenditure look like. The second step is fundraising. And here we're looking at how an organization will spend money from grants or investors. So if you're also fundraising to to implement a project, they will ask you, okay, if you get these funds, then how are you going to utilize them? And if you already have a budget, then you're able to know how the money will be utilized if you're able to get it. And then implementation, this is basically you're trying to monitor actual expenditure versus the planned expenditure. And then the monitoring and evaluation, you're trying to assess if the project was successful. So if in implementing this budget, we are able to achieve the results of the project, or we fell short in certain areas. And after that's done, then there's always steps to developing a budget. And here we're just trying to look at, as you're going through that whole budgeting process, what things should you try and look out for? So there are things like you have to identify the employees to be involved. So of course, this is an expense to your organization. So you have to identify the different employees that you want to actually involve in the execution of this project and understand if they are fit for the budget. You have to gather data and identify expenses. So before you just come up with different expenses, you have to go out and know the market prices of these different expenses you're going to add to try and fit into your project. And that enables you to create a realistic budget. So the budget should be something that you know fits within what your organization can do. Don't create a budget based off you planning for resources that haven't yet come through. Create a budget based off what you're sure is coming through or you already have as an organization. And you always have to try to match income with expenditure as you're creating this budget, because we're not going to spend what the organization doesn't have. That's when you come up with things whereby maybe employees are using their own money to implement projects just because they want to get them done. But that's not a good practice. You always have to plan for such expenditures. And yeah, you have to prepare for unforeseen events. And here I talked about the miscellaneous budget that you can always come up with. So that's the end of the budgeting topic. So here we shall just have a discussion on trying to identify the ongoing projects in your NGO. And here we can just think about how do we know where the income is coming from and what are the expenditures that are going to feed into these different activities. So do we know that we need staff? So yeah, what different income and expenditure things we have in place? So you can, also this is an opportunity to ask a question if you have, or also write something, just drop a comment in the chat about what you think of this. So I'll just hand this over to Jennifer and Valeria for a few minutes.
Thank you so much, Colin, for taking us through that session. And now we just want to understand where we are in terms of understanding and then go also into the discussion. So I think I'll give it to Valeria to share with us what's happening in the chat so that you get to understand in terms of the questions and then how to pick up the discussion of what we've been able to bring on board. Valeria, I invite you to share with us.
Thank you, Jennifer, and thank you, Colin, for the session. So we have currently 5 questions in the chat. The first one from Ruth. She's asking, when it comes to financial planning, is it important for an organization to have a budget set aside specifically for emergencies? Do I go on and ask the other questions too, Colin, or you take it one at a time?
Yeah, I'll take it one at a time.
Okay, great. So the question is, when it comes to financial planning, is it important for an organization to have a budget set aside specifically for emergencies? Okay,
thank you, Valeria, for that question. Yes, you can always do that, but what I would advise is because a budget, as you're doing a budget, you're going to have different items for different activities. So you could just try to have a miscellaneous section under those different activities, because now if you also try to create just an emergency budget, then that now it becomes like you're trying to implement two budgets at one time. So you could just try to have under every activity that you try to implement. So for example, if you have capacity building and trainings that you're going to do, and you list the different costs that are under there, you could always have a miscellaneous section whereby you try to see in case maybe, you take into attributes of maybe if the costs differ by this much, then this is what that's going to look like.
Thank you, Colin. So going to the next question, what is an activity budget and line item budget? Can you share a sample budget that details the same?
Sorry, Valeria, could you just repeat that question?
Yeah, sure. What is an activity budget and line item budget? And then she's asking if you could be able to share a sample budget.
Okay, I'll answer it based off how I've understood it. So an activity line, it's pretty much the same as a line item, because as you're trying to implement a budget, the line items come from the activities that you're going to try to implement. So a line item could be capacity building training, or that could also be an activity. So that could be an activity plan or a line item under your budget. And then you could always have the different costs under that. So if you're going to incur costs on transportation, you could look at, if you're hiring a car, you could look at how much you usually hire a car at, how many days are you going to spend using this car, what will the fuel costs look like. So it's just pretty much the same.
Thank you, Colin. So we go to the next question from Charles. At the strategic level, do we need to have the budget and budgeting in place?
Can you just repeat that?
Yes, he wrote, at the strategic level, do we need to have a budget and the budgeting process in place?
So yes, you should have the budget in place at the strategic level, because remember also the strategic, when you are at the strategic level, you're trying to look at the vision that you have in place and also the mission. So I think as I'd gone through the mission earlier, the mission looks at always the activities that fit into your whole strategic plan. So of course, as you're coming up with a strategic plan, there are going to be activities there. So it all just keeps flowing from the strategic level till the implementation level and also the project level. So usually as you're doing a budget, you have to look at the whole process from the strategy that you put in place into till the point when you are actually implementing this strategy, and then to the point when you are monitoring and evaluating this, and also to the point of the closure.
Okay, thank you, Colin. Charles, I saw that you asked 2 more questions, but I will take first questions from other participants that have already been typed in the chat, and then if there's time, we'll go back to yours. So this is a question from Anita. She's asking, how do you ensure that your organization's budget is at least 80% implemented? given that as an NGO fully reliant on donor funding, donor priorities often do not align perfectly with your plans? How do you effectively realign your budget to accommodate these constraints?
Yeah, thank you, Valeria, for that question. So I think as I had earlier highlighted, always as we're trying to create budgets, we should always try to see that your budget is something that's realistic and also something that you can achieve. So always as you're drawing up a budget for a project that you want to implement, it's always key to look at what are the resources that you have now, not the funding that you expect to come in the next, let me say, few months. Because if you do that, then you're going to realize that you're going to budget for things that will not happen. So it's always never advisable to actually budget for what you do not have. So I'll just try to put this in, let me say, a personal case. So for example, if I'm trying to, as an individual, I want to buy a car, and this car costs, let me say, 2 million Kenyan shillings, but I actually have about, I have, let me say, a million saved. So if I'm trying to, let me say, buy this car at the end of the year, I have to look at what are my sources of income looking like? What's my salary? If I have a salary, if I have any side income that's coming in, what does that look like? Is it consistent? And then I can make a plan on whether to save, or maybe I could go and get a loan and do this and try to pay this in installments. So unless you've understood the income that's coming in, you cannot create a budget based off what you anticipate. Because for example, in this example I've given, where you want to buy a car, you can't say that maybe in the next 6 months, if I'm working a 9 to 5, that my salary could be doubled. And then you make a plan to, let me say, get a loan to try and buy this car. That won't be sustainable, because what if this does not happen? So always as we are trying to plan for different activities, we should always start by planning for what we actually currently have, the incomes that we have now, and the expenditure that we are going through. How does that support my overall implementation of this budget? So it has to be realistic. Let's not create budgets just to try and maybe show that our organization is going places, but let's try to fit within what we currently have, incomes that we have, and also the expenditure that we can meet. I hope I've answered that clearly.
Thank you. And we'll take one more question from Omar. He's asking, how can we stay up to date on the latest trends in financial management for NGO in the wake of shrinking civic space?
Okay, I think the first step is just to have interest in the whole financial management process, and how that can really affect where your organization could go. And once you have that, then you be in position to pick interest in the different trends. There are always articles about how these things are evolving in different organizations, in different NGOs. I'm someone who likes watching YouTube, so I'm always coming into a number of channels that are actually supporting on these instances, because now I think financial management and financial literacy are at an all-time high, and there are so many people trying to publish resources that could help various organizations to try and plug into the different areas. LightUp, Impact, and KCDF, they were able to even come up with a very robust training manual. I don't know if they've shared that with you, but if they haven't, it's something that I believe they will be sharing with you. So it has a number of things that You could also refer to that on how NGOs could basically try to better their financial management practices. So there are a number of topics that we may not even be in position to touch here, but those are in the financial training manual, and yeah, you could always be in position to utilize resources like that. Also, there are different experts that you could always reach out to, and they could always support you also trying to implement these checks in your organization. Now, if you feel that you are not technical enough to try and implement this, then you can always seek support from those that you think would be in position to support you in that regard. I think that's all from my side, Valeria.
Thank you, Carlin. We have one more question. Always from Charles. Does the annual budget comprise of the operational and cash budget, or they are prepared and monitored separately?
Okay, so yeah, the annual budget you can always prepare them separately, or you can always merge them. It always depends on what's more convenient to you. You can always merge. Yeah, you can always merge all of them or separate them. There are some people who would want to look at all these budgets in the same place. There are people who would want to look at different budgets in, let me say, different Excel spreadsheets or sheets. So it's just basically what's convenient to you that you could always follow. So you could have one Excel sheet and have different schedules under there, or you could have different Excel sheets if that's easier for you.
Great, I think we're done. Unless anybody wants to speak now, we can move in the next session.
Okay, so yeah, we've come to our final session for today's training. And here we're just going to try to look into record keeping. So record keeping, we just try to look at what financial records are. And these are written accounts or copies of all useful information regarding financial and business activities. So here you're just looking at the different transactions that an organization goes through. So these transactions could either be income to the NGO, or it could be an expense to the NGO. How do you try to treat these? Because there are all sorts of different expenses, as I had shared earlier. Usually, if you're an NGO, maybe giving out a product, your costs or expenses are going to be different from that NGO that's just providing a service. So, of course, as you're trying to monitor these financial records, then there's going to be the record keeping element, which is basically how you log, store, and dispose of important financial information for your business. So it's always ideal to have these records kept very close to you, so as when someone asks you about anything that's occurring in terms of your financial records, you're able to access this very easy. So here we're going to look at the importance of financial records. And the first is improve financial management through enabling better tracking of income, expenses, and cash flow. So as an NGO, we have different income that's coming in. And if you keep financial records, you're able to fill into your financial record templates of on this day, this income has come in, this grant funding opportunity has come in, and on this day, we have met an expense of ABCD. And then it also provides a clear picture on financial health for decision making. So of course, if you know the income that's coming in and the expenditure, then you're able to make a decision on various things of your NGO, things like, can I acquire assets currently? Can I take on more staff to support in implementing of the project if I'm understaffed, or how do I try to navigate those areas? Do I take on more full-time staff or more part-time staff? Easier access to funding as it facilitates access to loans, grants, or investments by providing clear and reliable financial records to lenders or investors, as well as demonstrating financial responsibility and credibility. So, as I've shared, usually, different organizations always have that pain point of having sufficient capital to run their day-to-day organizations. So, I'll try to rank this. I'll try to give an example on a business perspective, because a number of businesses I support will come saying we need more money. For example, if they are doing coffee, we have gotten an order of supplying 50 tons of coffee, but we did not have the funds to actually go and access this coffee from the different from the different farmers or the different organizations. So usually when they come, they need to access a loan facility or an equity facility, but now the challenge always comes up when they do not have any financial records to show the lenders their cash flows. So if you do not have these financial records, then the lenders become skeptical of providing you with any funding. They will be like, we don't know how much money is coming into your business, how you're moving it out of the business. And that always makes it tricky for them to access different funding opportunities. So usually even these investors will ask for something as simple as a bank statement. But as you know, in Africa or in the Ugandan space that I'm at, people like cash transactions. But if you're doing cash transactions, then no one is able to see a record of how you have paid these suppliers versus how money has come into your business for providing this service or this product. So that goes to show that we have to try and implement financial recording in our entities, because as an investor, they would always want to know, do you have, if you have actually supplied this order, where is this money? But if you can't show where the money was put and how it was utilized, they get skeptical on things like the payment. Also, an organization like an NGO would maybe want to get an asset, since they plan on maybe money that's coming in after a future time period, but they would look at, let me say, let's first get a loan to buy this asset. But if they do not have now the financial records, it's going to be tricky to get someone to come on board with you to actually be in position to provide this funding to you if you don't have any records in place. The fourth is performance monitoring, as it helps to track business performance over time period by comparing financial records from different periods. So here you're able to you're able to monitor what your performance looks like over the previous years. So for example, if you've started your NGO 3 years ago, you can be able to use these financial records to see that what journey have I been able to walk before I had this income coming through, but now I'm at this level now. How do I try to increase that going forward? And it also supports on risk mitigation, identifies discrepancies, potential fraud, or financial risks early through regular record reviews. So, for example, if you have this income that you are well aware has to come in and be pegged to these different activities, usually as you're doing your monitoring and evaluation, you will see that maybe there's this income that was not spent on these activities, but the organization doesn't have it in its bank account. So this gives you a picture to now try and assess where could this money have been spent and how did this actually happen, what checks and procedures weren't in place. So that really financial records support on that. And going forward, there are 2 ways we can always try to keep financial records in our institutions. So there's the electronic record keeping way. There's also the manual record keeping way. So I'll start with the manual record keeping. And this one looks at mainly organizations that are just trying to start out, that are at the early stages and haven't really attained significant growth. If you're just starting out and maybe at some times you're not even sure of whether this whole model is going to be sustainable, you should always start with the manual record keeping, because it's something that's less expensive to set up, and it's something that can still help you to make these decisions. So for example, instead of having an automated system, you try to have, you could use your computer if you have one to set up Excel spreadsheets for different income accounts or different expense accounts, and then you keep filling those in there. Some people who are really in the remote areas that do not have access to a laptop, they start by getting things like payment vouchers. They will have, let me say, receipt books for, let me say, the incomes that are coming in. They will have invoice books. So all these different documents, just to ensure that they're in position to try and keep their financial records, and they could always at the end of the day hire an accountant on a routine basis. So, let me say quarterly, who comes and fills in this information into Excel, or try and create different financial statements for them. So this is always a process someone can start with. It's just recently that all these electronic and accounting softwares have come, but earlier in the days, especially earlier in the days in the 2000s, the 90s, very few people had access to this, but still the financial system was operating, and it was just based off these different manual record keeping procedures. So we have the electronic record keeping, and here we're looking at different accounting systems. So I'm sure some of you have heard of QuickBooks. There are things like Zoho Books. There are things like, there are softwares like Tally. There are things like Odoo, different softwares that different people are now utilizing. And that's because it's much easier. And if an organization has grown to the point whereby they have so many transactions coming in every other day, then it's going to always be tedious for someone to use manual record keeping. So electronic record keeping is something that's always looked at the growth stages, but also I've seen early stage enterprises also trying to use the electronic record keeping, because it just saves time. And at times, these early stage enterprises may not be making a lot of profit, but they also have a number of transactions coming through. But they are early stage because they have not really understood what their business model looks like. They still need years to try and get that into place. So electronic record keeping, you're just trying to automate the process whereby if a customer came and let me say, donor came and provided you money, you're able to reflect this into your system, and then you're able to show that to them. You're able to send them an e-copy of that. And the advantage of the electronic record keeping is your documentation is usually much safer. Things of like, in case your premises caught fire, if you have manual records like those different books, then there's always that risk that everything could be burnt and you would lose everything. But also the electronic side also has a thing whereby there's a risk of also your data getting corrupted due to a system hack and all that. So you just have to see how to balance that. But at least it provides you at times backups of the records, and you're able to keep them safe in case of fire or theft. So those are two ways one.
Sorry for the interruption. We have 5 more minutes for this part. Thank you.
All right, thank you, Jennifer. So here we try to look at the categories of financial records. So we have both supporting documents and books of accounts. So under supporting documents, these are documents that support any transaction that occurs in a non-governmental organization, and should maintain files with documents like receipts or vouchers for money received, or money paid out, invoices, different bank statements, payment vouchers, LPOs or goods received notes, and then books of accounts. These are used to just basically track all financial transactions. And NGOs need to maintain various books of accounts for proper systems. So these include like things you could have a petty cash book, you could have an asset register whereby you highlight the date you've been able to purchase this asset, how much has been spent, what's the depreciation percentage on this asset, if it's something like a vehicle. You should have things like the salary register whereby you're able to highlight the stuff you have, how much are they being paid, how is their pension being paid, or their taxes and things like that. And then a register of grants that you have received that are coming into the organization. So those are some of the financial records one can look at in their entity. And now here, we'll just try to review a sample income statement. So that will always come from an assessment of the financial records that one has come up with for a financial year. So this is what it looks like, and this will always vary based off the sector that you are in. If you are an NGO, that's going to look different from that of a for-profit venture. So this is something for profit, but the difference here is there won't be, because if it's a non-profit, then you're not paying taxation because you're not making any profit. You're just using most of this income to implement the projects that you set out to do. So, but at times I've also seen these NGOs having a profit because maybe some of the funds have not been utilized, but that's not liable to taxation. So what happens is these organizations will move that profit to the next year and maybe implement more activities. So there's an NGO in Uganda. So it's called Infectious Disease Institute. I don't know if you've heard of it, but I was interacting with them earlier this year, and they were sharing how I think the last period they had made a profit because they always have a number of projects that they're running and a number of proposals that they put out. So most of this profit was actually provided to Makerere University, the research institute, to see how they can now try to utilize that. So this profit, we always look at things like revenue. So the revenue can also be income. So as an NGO, this income could come from that, it can have other income from the donor agencies, or this could also come in whereby you are trying to cost share certain expenses with the different people you're targeting just to try and have more money to create sustainability. So if you're cost sharing and these people are paying for some of that, then that can always come into as a component of revenue. Cost of goods sold will always come up if you are supplying a product. So if you are really supplying this product, or let me say, if you're supplying any product to any of your audience or any of the participants or target groups that you're supporting, there are always costs of acquiring that product, or if you are actually producing that product, there will always be those costs that look at that. And then when you subtract revenue minus cost of goods sold, you get the gross profit, after which you now look at the operating expenses of your entity. So things like utilities, salaries and wages, rent, advertising, insurance, if you have a vehicle. If you also have other assets, there could be depreciation costs there. So all these vary based off what your organization looks like and the growth stage it's at. After which we have operating profit that's gotten by simply subtracting the gross profit, simply subtracting the operating expenses from the gross profit. So you get operating profit. And that operating profit for an NGO becomes a net profit. If you are a business, if you have profit, then it's liable to taxation. In Uganda, it's about 30% for organizations. So you have that net profit there. So yeah, that's basically what a sample income statement looks like. And I believe at this point we have come to the tail end of our second training session that focused on financial planning, budgeting, and record keeping. So here I'll just open the floor up to any questions and answers that are there. We shall just take a few because of the time, and I'll hand it over to Jennifer and Valerie.
Hi, Colin. Thank you so much for that session. We have a couple of questions from the chat. The first question is from Helen. What are the benefits of displaying an organization's financial reports in public spaces, such as the website, reflection meeting, or any other media? Are there any risks in publishing financial reports or audits? Thank you.
So yeah, if you are doing the financial audits, right? I don't think there's always a risk of any financial risk, because as you try, if all this is being done in the right processes and you're following all the regulations, there are never any risks. It all depends on if you want to do that, because that also varies if you are a public company or a private company. So you realize usually it's public companies whereby they are trying to create, just trying to give comfort to the different shareholders in their institutions that will always publish these reports. So for example, I'll look at, let me say, Safaricom. Since there are a number of shareholders in that company, they always publish these annual reports to give comfort of how, let me say, dividends were paid to their shareholders and the like. For a private company, this is not something that you are actually mandated to do. So what you would have to do is just provide those reports to, let me say, the people that you are accountable to. If you have any donors that have requested for this, you could provide that to them. So yeah, it all depends on what your company looks like. If you have different stakeholders with interest in those companies, then yeah, it's always advisable to provide those to them. So there's never a financial risk if everything is done well, because also at a certain point, maybe if you're going to now look at more investors to come take part in your organization, these are some of the things they will ask for. So yeah, we just try to do everything following the different accounting standards that we try to go through in the first session. But yes, that's what I can advise on that.
Thanks, Colin. Michael is asking in the chat, it's not a question, but he's asking if you can move to the slide of, I think, of the income statement. I think that's what he means, because he was writing something. So maybe if you can move to that slide as we continue the Q&A. We have also a question from Ruth. She's asking, is it mandatory for the financial reports to be audited by an independent auditor? If so, what happens when we do not have a budget for the same? Can we rely on the reports from finance as the final interposition of the organization?
You can always rely on them, but there's always a risk as an internal. There's always that risk relying on those management accounts. But if you don't have budget, you can always start by those. They could give you a picture. But why it's always advisable to try and do an external audit is just because you're bringing in someone who is independent. I'll just give you a situation. If the finance team maybe decided to utilize funds for something else or something that's personal, and you utilize and use that information, it will be something that they are able to hide away because they're the ones in charge of everything. So it's always just trying to remove that risks and trying to detect if there's any fraud or theft in your organization. That's why those external audits are always done. And also at times you could be, your finance team could be doing procedures in a way that's not, doesn't try to look at what the accounting standards try to follow. So those external audits really try to support, but also as you're always trying to do those external audits, try to get people who are actually, who you believe are qualified for that job and will not, let me say, collude with the internal staff, because that's something that SMEs have supported are going through, whereby they will have even external audited accounts, but they have not been done professionally. So it's just always to try and avoid those risks and just have those checks. And also as an internal person, you always have bias to certain things. So bringing in that external element just tries to remove all that bias and just try to give you an accurate standing of what the organization tries to look like. If at times also as a manager, if you have a background in in accounting or finance, then that would help support you as you look at the internal accounts. But if you don't, then it's always advised to try and budget for that.
Thank you, Colin. And we have one more question from Dorcas. So organizations should have budgets and work plans even without funding?
That really depends. Are you using personal resources to try and run your operations? Because if you do not have any resources, then that means you cannot run any project. So, and if you don't have any resources, that means you can't budget for anything. Yeah. I heard Valeria said that was the last question. So yeah, I'll just proceed to the next steps. And I'll hand this over to Jennifer as well as the KCDF team. And yeah, thank you for taking that time. And it's been a good session, very interactive. And we'll look forward to the third session, which would be trying to focus on compliance, risk management, and grant management. Thank you, and over to Jennifer.
Thank you so much, Colin. In regards to the Q&A, so I think there are some questions that probably, if there are any in the chat, I will request you to just, go to the chat and help us answer some few that will be able to assist the participants in terms of what they had. On the same, I just want to take this opportunity to thank you for the training. Colin, thank you for taking us through this session today on budgeting. Pleased to have some learnings that we're taking home from this session, and also the participants for just being, engaging and just asking the questions so that all align in terms of understanding where we are for organizations on financial planning. For these steps, allow me to invite Kennedy from KCDF to just take us through the next steps as we come to the tail end of this training. Kennedy, you're most welcome.
Thank you. Thank you, Jennifer. Thank you, Collins, Valeria, for kind of anchoring this and making sure that the session has gone on very smoothly. I would also want to thank the participants for their engagement and the fact that I was monitoring the participants, and you find that the attendance has been very consistent throughout the session with the additions at different stages. So I believe that people are getting knowledge and skills on how to manage their finances. And as the facilitators have mentioned, we'll be having a last session on 5th, which will also just strengthen our financial management systems as non-for-profit and organizations that kind of implement programs that benefit the communities that we serve. I would just want to announce that this training will continue online I know because of time constraint, we cannot cover the whole manual in our virtual training. So we are encouraging people to, I hope by next week, our e-learning will be up and running. We encourage those who are still interested to dig deep into the training to join the e-learning sessions, which will be sharing, which has been shared already under the East African Financial Resilient Hub. We will be having all these sessions posted there starting next week. And we hope that people can still go back and, dig deep and learn more. And that is at the point where we'll give you certificates. As my colleague Boniface had said, we are doing this to make sure that organizations have the requisite tools to manage the organization with the different departments, be it HR and admin, finance. We'll be talking about other upcoming modules like risk management, data protection. We'll talk about program design and development and other topics. So we'll be informing you. We'll be just keep on the loop. We'll be informing you when these sessions are running, because I believe we'll just have a small break after 5th, but we'll continue having several sessions running to make sure that organizations have systems and structures to enable them be more risk and to make them more attractive to potential donors and funders. Otherwise, we look forward to seeing you again on Thursday, and we hope that most organizations will complete these 3 sessions and also log in into the other online sessions. Otherwise, asanteni sana, and looking forward to seeing you again on Wednesday. I would also want to thank my colleagues at KCDF, the LightUp team, and the facilitator, and also not forgetting our sponsor, who is Femi Foundation, for enabling us do this. Otherwise, we are grateful and looking forward to seeing you again on Wednesday.